In most financial cycles, stress shows up slowly. Credit tightens, lending standards rise, markets wobble. Then policy steps in, and calm returns. That rhythm has repeated for decades. But today, something feels different. Gold is climbing toward levels few analysts predicted even a few years ago. The idea of $5,000 gold was once considered extreme, almost symbolic. Now it is part of serious conversations among institutional investors and central banks. At the same time, many global banks appear stable on the surface, well capitalized, regulated, and supported by central banks. Yet beneath that surface, pressure is building. This is the paradox. If the financial system is sound, if inflation is moderating, if growth is slowing but not collapsing, then why is gold behaving as if confidence is eroding? Why is capital quietly moving into an asset that does not generate yield, does not depend on earnings, and does not rely on promises? Gold tends to move when trust shifts. To understand this moment, we have to separate headlines from structure. Markets often react to news, but structural tension builds over years. For more than a decade, interest rates remained near historic lows. Governments borrowed heavily. Corporations refinanced at minimal cost. Banks loaded their balance sheets with long-duration bonds that seemed safe in a world of stable inflation. Then inflation returned. To contain it, central banks raised interest rates at the fastest pace in modern history. That shift changed the math of the entire system. Bonds purchased at low yields suddenly lost market value. Commercial real estate, financed at cheap rates, faced refinancing at much higher costs. Sovereign debt rolled over into a more expensive funding environment. None of this caused an immediate collapse, but it created a new condition: fragility beneath apparent stability. Banks operate on confidence. They borrow short and lend long. They hold assets whose value depends on interest rates and economic growth. When rates rise quickly, the value of older bonds falls. When growth slows, credit quality weakens. If depositors remain calm, the system absorbs these pressures. If confidence wavers, liquidity becomes the focus. This is where gold re-enters the picture. Gold does not depend on someone else's liability. It carries no counterparty risk. It is not tied to quarterly earnings or refinancing schedules. When institutions quietly increase gold reserves, they are not betting on catastrophe. They are hedging against systemic uncertainty. And that uncertainty is growing in specific areas. Sovereign debt levels across major economies are at historic highs relative to GDP. Servicing that debt becomes more expensive as interest rates rise. Commercial real estate markets face vacancies and refinancing cliffs. Regional banks, especially those heavily exposed to property loans or long-duration securities, must manage shrinking margins while maintaining depositor trust. Individually, each issue appears manageable. Collectively, they form a web of pressure. So when gold approaches higher thresholds, it may not be predicting immediate collapse. It may be signaling that the system is entering a new phase, one where the tools used to stabilize the last crisis now create constraints in the next one. This brings us to the core disruption. The same low-rate policies that supported banks after previous downturns encouraged leverage, long-duration risk, and asset inflation. When rates normalized, those positions became vulnerable. Banks cannot easily sell underwater bonds without realizing losses. Governments cannot easily cut spending without slowing growth. Central banks cannot easily lower rates without risking renewed inflation. In that sense, the system appears trapped, not in crisis, but in tension. Gold rising toward $5,000 is not just a price story. It is a narrative threshold. If reached, it would imply a significant repricing of confidence in paper assets relative to hard assets. It would suggest that markets are adjusting to a world where debt is structurally high and monetary flexibility is constrained. The question is not whether banks are collapsing. Most are not. The deeper question is whether the policies designed to prevent collapse have quietly limited future options. If rates stay high, balance sheets strain. If rates fall quickly, currencies may weaken. Every path carries trade-offs. This is why gold and banks now seem to move in opposite psychological directions. When trust in policy strength rises, gold often stalls. When doubts about long-term stability grow, gold strengthens. We are watching that divergence unfold in real time. But to understand whether this is temporary noise or a true structural signal, we need to look at what has changed beneath the surface. Because markets follow patterns, and when those patterns break, they rarely do so without reason. To see whether this divergence is noise or signal, we need to revisit the basic rules that governed markets for decades. For most of the modern financial era, the relationship was clear. When interest rates rise, currencies tend to strengthen. Higher yields attract capital. Stronger currencies reduce the appeal of gold because gold does not pay interest. Investors prefer yield-bearing assets when returns are attractive and inflation appears contained. In that framework, gold usually rallies during crises or during aggressive monetary easing. When central banks cut rates, weaken currencies, or expand balance sheets, gold responds positively. When policy tightens, gold often cools. But that pattern is no longer holding in a clean way. Over the past several years, rates have risen sharply. Bond yields moved to levels not seen in more than a decade. By traditional logic, that should have placed sustained pressure on gold. Yet gold has remained resilient, even strong, while yields fluctuate at elevated levels. That is a rule breaking. When long-standing correlations weaken, markets are often signaling a deeper transition. It suggests investors are no longer reacting only to short-term rate levels. They are responding to something more structural. This is the big signal. Gold is rising not only during moments of panic, but during policy tightening and fiscal strain. It is gaining ground in an environment of high nominal rates and record sovereign debt. That combination forces us to ask a more serious question. What are markets pricing beneath the surface? To answer that, we need to examine how banks positioned themselves during the era of near-zero rates. For more than a decade, government bonds were considered both safe and liquid. Banks accumulated large portfolios of long-duration treasuries and mortgage-backed securities. At low yields, these assets provided stable income relative to funding costs that were also extremely low. But duration risk is subtle. When rates are stable, it barely registers. When rates rise quickly, it becomes powerful. A bond purchased at a 1.5% yield loses market value if new bonds are issued at 4 or 5%. The math is mechanical. The longer the bond's maturity, the larger the price decline. These losses do not immediately appear on income statements if the bonds are held to maturity. They sit as unrealized losses on balance sheets. As rates surged, unrealized losses across the banking system quietly expanded. At the same time, funding costs began to rise. Depositors, aware of higher yields elsewhere, shifted funds into money market accounts or demanded better rates. Banks faced a squeeze, assets earning lower fixed yields, liabilities becoming more expensive. This is how balance sheets can deteriorate without a headline event. No single loan defaults. No dramatic trading loss occurs. Instead, margins compress. Capital ratios tighten. Liquidity becomes more important than growth. Management teams shift focus from expansion to defense. When we view gold through this lens, its strength appears less speculative. It looks more like a hedge against the long-term consequences of this imbalance. The traditional model assumed central banks could always cut rates in response to stress. But in a world where inflation remains sensitive and debt levels are historically high, that flexibility is reduced. Lowering rates too quickly risks currency weakness or renewed price pressure. Keeping rates high prolongs balance sheet strain. That tension is new. It explains why gold can rise even when rates remain elevated. Investors may be less focused on the absolute level of rates and more focused on the sustainability of the entire framework. In other words, gold is not reacting to today's yield. It is reacting to tomorrow's constraints. When sovereign debt climbs while interest costs rise, governments face difficult choices: raise taxes, cut spending, inflate away liabilities, or accept slower growth. None of those paths are painless. Markets sense these trade-offs long before they become visible in policy statements. This is why gold's move toward higher narrative levels matters. It is not predicting immediate collapse. It is reflecting uncertainty about the durability of the current monetary architecture. The rules are not fully broken, but they are bending. When correlations shift, it often marks the early phase of structural change. To understand how deep that change might run, we must look beyond balance sheets and policy rates and examine who truly controls the underlying resources and leverage within the global system. If correlations are bending and traditional signals are weakening, then we have to step outside the financial screen and look at something more tangible. Gold is not just a ticker symbol. It is mined from the ground, refined through specialized facilities, transported across borders, and stored in vaults under sovereign control. Its supply grows slowly, often less than 2% per year. New discoveries take years to develop. Permits, environmental reviews, financing, labor, and infrastructure all stretch timelines. This is not a digital asset that can be expanded with a keystroke. That physical constraint is the first layer of the real battle. Gold production is geographically concentrated. A handful of countries dominate mining output. Refining capacity is also clustered, with certain regions controlling the transformation of raw or into investment-grade bars. Above ground, large portions of global gold reserves sit on the balance sheets of central banks. Who controls those reserves matters. In recent years, central bank accumulation has accelerated, particularly among emerging markets. Some of these countries have increased gold purchases to diversify reserves away from heavy reliance on the US dollar. This shift is not loud. It does not always make daily headlines. But over time, the trend becomes visible in the data. When central banks buy gold, they are not chasing short-term returns. They are managing strategic risk. They are thinking in decades, not quarters. To understand why, we have to consider how global trade actually functions. Energy, food, metals, and manufactured goods move along trade corridors that depend on payment systems. For decades, the dollar has dominated those settlement flows. Most global commodities are priced in dollars. International banking networks clear transactions through dollar-based infrastructure. That system gives the United States and its allies significant influence. But influence also creates vulnerability. Sanctions, trade disputes, and geopolitical tension have encouraged some nations to explore alternative settlement mechanisms. Bilateral trade agreements denominated in local currencies, regional payment systems outside traditional networks, commodity deals settled in non-dollar units. None of these changes overturn the existing system overnight, but they introduce friction. They create parallel channels. And in that environment, gold becomes more than a hedge. It becomes neutral collateral. Gold does not depend on a specific country's legal framework. It does not require access to a particular payment network. It can be pledged, swapped, or transferred between central banks without relying on a third-party issuer. This is where the concept of confidence versus control becomes clearer. Banks operate within a web of regulatory oversight and central bank backstops. Their strength depends on trust in that framework. Gold operates outside that web. Its value rests on physical scarcity and collective belief accumulated over centuries. When emerging market central banks accumulate gold, they are not rejecting the current system outright. They are reducing dependence. They are building options. At the same time, large commodity producers are reassessing settlement terms. Energy exporters, for example, may accept payment in multiple currencies or link contracts to baskets rather than a single benchmark. Over time, this shifts the demand dynamics for reserve assets. If trade becomes more multipolar, reserve composition may follow. This does not mean the dollar disappears. It means the system becomes more complex. Power fragments, influence diffuses. And in a fragmented system, hard assets that do not rely on any single issuer can gain relative appeal. The move toward higher gold prices must be viewed in this context. It is not simply retail investors reacting to inflation headlines. It is sovereign actors recalibrating exposure to currency risk and payment leverage. The real battle is not banks versus gold. It is confidence in centralized monetary authority versus control over independent stores of value. Banks depend on depositors, believing their claims are sound. Governments depend on bond buyers, trusting fiscal sustainability. Payment systems depend on geopolitical stability. Gold depends on none of these directly. As global supply chains reorient and trade alliances shift, financial architecture slowly adjusts. Each adjustment may appear incremental, but when layered over years, the cumulative effect can be substantial. If gold were to approach $5,000, it would not only reflect investor fear, it could reflect sovereign repositioning, a gradual repricing of physical collateral relative to paper promises. That realization shifts our perspective. The issue is no longer confined to bank balance sheets or interest rate cycles. It extends into the structure of global trade and reserve management, and once we move into that realm, the next question becomes unavoidable. How do these shifts in power and collateral flow back into currencies themselves? And what happens to money when the foundation beneath it begins to realign? When trade corridors shift and sovereign reserves begin to diversify, the implications do not stop at commodities. They flow directly into the core of the financial system, money itself. Modern banking is built on leverage and maturity, transformation. Banks take short-term deposits and turn them into longer-term loans and securities. That structure works because depositors trust they can withdraw funds on demand, and because asset values are assumed to remain broadly stable over time. Confidence bridges the gap between short-term liabilities and long-term assets. But confidence is not a line item on a balance sheet. It is a shared belief. When asset values fall while liabilities remain fixed, that belief becomes the stabilizing force. If depositors and investors trust that assets will recover, they remain patient. If that trust weakens, liquidity stress emerges quickly. Now expand that logic from banks to governments. Governments borrow by issuing bonds. Those bonds are purchased by domestic institutions, foreign central banks, pension funds, and individuals. The promise behind each bond is simple: future repayment with interest, denominated in the national currency. As long as investors believe the currency will retain purchasing power, the system functions smoothly. But when debt levels rise faster than economic growth, refinancing becomes more sensitive to interest rates. Over the past decade, many sovereigns issued large amounts of debt at historically low yields. As that debt matures, it must be refinanced at current market rates. If rates are higher, interest expenses increase. Larger interest expenses widen fiscal deficits unless spending is cut or taxes are raised. This is where currency credibility enters the conversation. A country with rising deficits and growing debt to GDP ratios faces limited choices. It can impose austerity, which slows growth and risks political backlash. It can raise taxes, which may dampen investment. Or it can rely on monetary policy to ease financing conditions. If monetary authorities support bond markets too aggressively, the currency may weaken. If they do not, borrowing costs may remain elevated, increasing fiscal strain. Gold's rise intersects with this dilemma. When gold appreciates strongly in a high-debt environment, it can signal concern about long-term purchasing power. Not necessarily runaway inflation tomorrow, but gradual erosion over years. Investors may be hedging against the possibility that future policy responses will favor debt. Sustainability over currency strength. It is important to be precise here. Rising gold does not automatically mean hyperinflation or collapse. It can also reflect portfolio diversification, geopolitical uncertainty, or central bank reserve adjustments. But when gold approaches major psychological thresholds, such as $5,000, the structural implications become harder to ignore. At that level, gold would represent a significant repricing relative to bonds and fiat currencies. It could imply one of several outcomes. First, severe currency debasement, where inflation meaningfully reduces real debt burdens. Second, a policy reset, where monetary systems are adjusted through new frameworks, reserve arrangements, or partial backing mechanisms. Third, a broad repricing of real assets versus paper claims, reflecting a shift in how markets value tangible scarcity. Each scenario points to the same underlying issue: the constraint imposed by debt. In highly leveraged systems, Flexibility narrows. Policymakers must balance financial stability, price stability, and fiscal sustainability. Achieving all three simultaneously becomes difficult when debt levels are elevated and growth is modest. This is why sovereign debt metrics matter more than short-term stock market swings. Equity markets can rally even while fiscal pressures build quietly. Bond markets, however, reflect funding realities. If investors demand higher yields to compensate for risk, the cost of maintaining the system rises. Gold's strength in this environment acts as a mirror. It reflects questions about long-term monetary durability. It asks whether fiat purchasing power will remain steady over decades, not months. As we move from banks being constrained by interest rates to governments being constrained by debt, the story becomes less about isolated stress and more about systemic limits. And when systems face limits, individuals begin to feel the effects, sometimes slowly, sometimes suddenly. That brings the focus closer to home. If currencies, banks, and sovereign balance sheets are adjusting beneath the surface, what does that mean for households, businesses, and long-term financial planning? When systemic limits begin to tighten, the effects rarely appear first in headlines. They show up in small shifts: a loan application that takes longer to approve, a mortgage rate that feels unexpectedly high, a savings account that earns more interest but buys less over time. To understand these shifts clearly, it helps to use simple mental models. The first is the balance sheet lens. Every household, business, bank, and government has assets and liabilities. Assets generate income or hold value. Liabilities require payment. When interest rates rise, liabilities tied to variable rates adjust quickly. Assets often adjust more slowly. This mismatch creates pressure. If a bank holds long-term bonds, paying low yields while funding costs rise, margins shrink. If a household carries adjustable rate debt, payments increase while wages may not keep pace. The same dynamic plays out at the sovereign level when governments refinance debt at higher rates. Looking at the world through a balance sheet lens clarifies risk. It shifts the question from are markets up or down to how resilient is this structure if costs rise or income slows. The second model is the confidence loop. Liquidity depends on trust. Banks can operate with leverage because depositors believe funds are safe. Governments can borrow at low rates because bond buyers trust repayment in stable currency. When trust strengthens, capital flows easily. When trust weakens, capital retreats. This loop is self-reinforcing in both directions. Strong confidence lowers borrowing costs, which supports growth, which further strengthens confidence. But if doubt emerges, higher borrowing costs can slow growth, which deepens doubt. Gold's rise can be viewed as a subtle signal within this loop. It does not break the system by itself, but it may indicate that some participants are adjusting expectations about long-term stability. The third model is the real versus paper divide. Paper assets, stocks, bonds, deposits are claims on future cash flows. Their value depends on policy, earnings, and economic performance. Real assets, land, energy, metals represent tangible scarcity. Their value depends on supply and demand in the physical world. When financial conditions are stable, paper assets often outperform because leverage and growth amplify returns. When uncertainty about currency or credit rises, real assets can gain relative appeal. Understanding this divide helps explain why gold can strengthen even without immediate crisis. It may reflect gradual rebalancing between financial claims and tangible collateral. The fourth model is the time horizon model. Short-term volatility can obscure long-term trends. Over months, markets react to data releases and policy meetings. Over years, structural forces such as demographics, debt levels, and productivity shape outcomes. Systemic adjustments often unfold slowly. Credit tightens incrementally. Lending standards become more conservative. Small businesses find financing slightly more expensive. Housing markets cool as mortgage rates rise. None of these changes signal collapse, but together they reshape economic momentum. Currency shifts influence households in quieter ways. A weaker currency can make imports more expensive, affecting everyday goods. Persistent inflation can erode savings even when account balances appear stable. Retirement planning becomes more complex when real returns are uncertain. The purpose of these models is not to predict crisis. It is to build clarity. When we understand that leverage amplifies stress, that confidence drives liquidity, that real assets compete with paper claims, and that time horizons matter, we are less likely to overreact to noise. We can observe structural changes with steadiness rather than fear. History shows that financial systems rarely fail without warning. They evolve, pressures build, adjustments occur. Then, at certain moments, change accelerates. The question now is not whether change is happening. It is how far it might go, and what paths lie ahead if debt constraints, currency credibility, and sovereign strategy continue to converge. To explore that, we need to step into possible futures and consider how this story could unfold from here. As we look ahead, it is important to approach the future with structure rather than emotion. Financial systems are complex and adaptive. Policymakers respond to stress. Markets adjust to incentives. Outcomes are rarely linear. Instead of predicting a single path, it is more useful to outline plausible scenarios. The first is the stabilization scenario. In this path, central banks manage to balance inflation control with financial stability. Interest rates remain restrictive long enough to anchor expectations, but not so high that systemic cracks widen. Banks gradually rebuild capital through retained earnings. Unrealized bond losses shrink over time as securities approach maturity. Commercial real estate finds a clearing price, painful but manageable. In this environment, gold may remain firm but contained. It could trade below the symbolic $5,000 level, reflecting caution rather than crisis. Sovereign debt burdens remain high, but growth stabilizes enough to prevent a funding spiral. The system does not reset, it adapts slowly. This outcome would not feel dramatic. It would involve years of constrained growth, tighter credit, and disciplined fiscal choices. Markets would adjust to a world of structurally higher rates and more limited policy flexibility. The second path is the currency adjustment scenario. Here, the strain of high debt and geopolitical fragmentation leads to gradual currency realignment. The dollar does not collapse, but it weakens over time relative to real assets and certain foreign currencies. Commodity producers diversify settlement mechanisms. Central banks continue increasing gold reserves as a neutral anchor. Under this scenario, gold's move toward $5,000 unfolds over several years rather than months. The price rise reflects not panic, but repricing, a recalibration of purchasing power in a multipolar financial world. Bond markets would remain functional, but yields might stay structurally higher to compensate for fiscal risk. Governments would face persistent trade-offs between spending priorities and borrowing costs. The adjustment would be steady, not explosive. The third path is the confidence shock scenario. In this case, a specific event accelerates underlying tensions. It could be a sovereign funding scare, a major banking failure, or a geopolitical disruption that fractures payment systems. Confidence, once shaken, would tighten liquidity rapidly. Capital would seek perceived safety. Gold could approach or exceed extreme levels quickly as investors and institutions move to reduce counterparty exposure. Bond yields could become volatile, not only because of inflation expectations, but because of uncertainty about fiscal credibility. Policymakers would respond aggressively. Emergency liquidity facilities, coordinated interventions, and possibly unconventional measures would return to the forefront. Whether such actions restored trust or deepened skepticism would depend on timing and communication. None of these scenarios is predetermined. Each depends on policy decisions, economic growth, geopolitical stability, and collective psychology. Markets are not static machines. They are networks of human expectations. What unites all three paths is constraint. Debt levels limit flexibility. Demographics shape growth. Political realities influence fiscal reform. Gold's trajectory becomes a barometer of how those constraints are perceived. If gold approaches $5,000, it would not simply mark a milestone for a commodity. It would suggest that markets are reassessing the balance between paper promises and tangible stores of value. It would imply that trust in long-term monetary frameworks is being tested. And that brings us to a deeper question. Gold often reacts to stress in currencies and banks. But beneath both lies the bond market, the foundation on which modern finance rests. Sovereign bonds anchor pricing models, collateral systems, and global reserves. They determine funding costs for governments, corporations, and households alike. If gold's rise signals structural reset, what does that mean for the bond market itself? What happens if investors begin demanding higher compensation not just for inflation, but for fiscal uncertainty? That question leads directly to the next stage of this story, an examination of sovereign debt, treasury markets, and whether the true pressure point in the global system lies not in gold, but in the world's largest pool of government bonds.